So how do you use dividend reinvestment plans to strengthen your portfolio through market volatility? How can you use this particular plan, dividend reinvestment plan, to strengthen your portfolio in times of market volatility? That is the focus of this video. So in order to implement this particular concept, you need to consider number one, dollar cost averaging. Dollar cost averaging. And so you need to incorporate, consistent reinvestments, during period of market volatility. Dividend reinvestment plans, help investor maintain a steady investment strategy by automatically reinvesting dividends into additional shares, regardless of the stock price fluctuation. You just keep on buying. As a dividend comes in, you buy, regardless of the prevailing market price of the company shares. This process, known as dollar cost averaging, can reduce the impact of market timing as investors buy more shares when prices are low, and also fewer shares when prices are high. So it kind of smoothens your entry price, your buy price is smoothened. It averages out itself. There's it's also smoothing price and volatility by buying at different price points over time. Dividend reinvestment plans reduce the emotional impacts of market swings, helping to smooth out the effects of market volatility on portfolio growth. So you buy at the top, you buy at the middle, you buy at the bottom. So you have an average price at the end of the day. So it smoothens out your price, and then it equally mitigates volatility. Number two is compounding returns. Compounding returns. So when it comes to compounding returns, we equally deal with exponential growth. So this plan enables the reinvestment of dividends into additional shares, allowing compounding returns to take effect as you reinvest into buying more shares. At the end of the day, discover that compounding will take effect, in the shares you bought. So even during market downturn, the reinvested dividends can still generate future growth as the additional shares purchased through the plan will continue to earn dividends, which in turn will be reinvested. So it has a tremendous, compounding benefit. Dividends, earning more dividends, and dividends, buying additional shares. The entire process is quite fantastic. So long-term benefits. So over time, the compounded growth from this plan can help investors recover from market volatility and then capitalize on the eventual market recovery as the reinvested dividends, are also put to work. So as you are reinvesting your dividends, you are putting your capital to work. So in times of market recovery, discover that your position will perform tremendously. It will do very well. Number three is reduce timing risk. Reduce timing risk. In this case, you avoid market timing mistakes. You avoid mistakes that are linked to market timing. And so market volatility can tempt investors to react impulsively, making poor decisions based on short-term price movements. You may allow the noise in the markets to affect your trading behavior. And so this particular plan reduces the pressure of market timing as the automatic reinvestment strategy, focuses on long-term growth rather than on short-term price changes. And in addition, you have mitigating emotional trading. It helps to mitigate emotional trading. So investors are less likely to panic or try to sell to time the market when they have this particular strategy in place, allowing them to avoid making emotional decisions during times of market stress. So everything is like automated. So you cannot really have the leeway of making emotional decisions, because of the automatic procedure involved. Number 4 is lower purchase cost during market dips. Lower purchase cost during market dips. So buying more shares, on a down markets. When the markets or specific stocks experience a decline, a dividend reinvestment plan automatically purchase more shares at a lower price. Remember that it acts like a kind of dollar cost averaging. So whenever dividends are available, you just buy. Whenever dividends are paid, you buy. Whenever dividends are paid, you buy. So it kind of help you to buy. Even in a down market, you buy. And stocks are going down because the entire thing is like automated. You still keep on buying. And so this can significantly increase the number of shares held, which could result in substantial growth when the market recovers. There's also a kind of strategic benefits to this plan. Strategic benefits here. So by continuing to reinvest during downturn, these plans allow investors to take advantage of lower prices, helping them benefit from the eventual recovery of the stock value, helping them to benefit from from the recovery of the stock values. So not only that, you have number 5 is resilience in volatile market. The markets could be volatile at times, and so this plan provides a level of resilience. So stability in income stream. So these plans, work particularly well in a volatile market because they focus on steady income generation, through dividends. Even when stock prices fluctuate, dividends, can continue to be paid, providing a stable source of reinvestment and growth. Even when the market itself is down, companies, as long as they make profits, they keep on paying dividends. So you could still reinvest at even at a lower stock price. So you probably have improved, income stream. So focusing on long-term growth. So in a volatile period, this plan offers investors, it helps investors to stay focused, on long-term goals. Long-term goals by ensuring that growth continues throughout the reinvestment of dividends. Even if the market condition, is kind of less favorable, you just keep on purchasing. Since the entire procedure is like automated, in what's from a market condition, you keep on buying. Generally, the lesser price you buy your stock at, the more your overall profit will be at the end of the day. Number 6 is encouraging patience and discipline. Encouraging patience and discipline. So this is a long-term strategy. It's not for those who have short-term tendencies. No, we are investing for the long run, and so this plan encourages a long-term investment horizon, which is especially important during periods of market volatility. By sticking to a disciplined, automatic, investment strategy, investors can weather market fluctuations and allow their investment to grow steadily over time. Since everything is automated, you just relax, and then the system will do virtually everything for you. So you avoid a kind of knee-jerk reaction. You avoid panic. And so since this particular plan automatically reinvest dividends, investors are less likely to make hasty decisions based on short-term market movements or noise, helping them to stay on course with their long-term financial goals. And so in conclusion, Dividend reinvestment plans, offer a powerful tool for portfolio growth, particularly during periods of market volatility by facilitating a kind of dollar cost averaging approach, compounding returns, as well as reducing emotional decision making. The plans also help investors maintain, a steady investment strategy even during market swings. It's a wonderful plan you could key into if you so desire.